Okay, so last week something happened that didn't make the front page of most newspapers but probably should have. Banks borrowed over $50 billion from the Federal Reserve in 1 week. Now, if you're not in finance, that might not sound like a big deal, but let me put it this way. That's the highest level of emergency borrowing we've seen since this lending facility was even created back in 2021. And here's the kicker. This is happening right in the middle of a government shutdown. Federal workers aren't getting paid. SNAP benefits are delayed. Medicare premiums are about to jump. And suddenly, banks need $50 billion in emergency cash. Listen, those things are connected. And today I'm going to walk you through exactly why banks needed that money, what it has to do with the shutdown, and most importantly, what it means for your savings. Because here's the thing, this isn't just political noise. This is a warning sign that the financial system is under real stress. Let's break it down. All right, here's what we're covering. First, I'm going to explain what actually happened with this $50 billion, what banks were doing and why it matters. Second, we'll talk about how the government shutdown is making everything worse and why the timing is so dangerous. And third, this is the big one. I'm going to tell you what this could mean for your money and what you should actually be watching for in the coming weeks. Let's get into it. Okay, so first, let's talk about what actually happened. The Federal Reserve has this thing called the Standing Repo Facility. Basically, it's an emergency cash window for banks. When they need money fast, they can hand over safe assets, things like treasury bonds or mortgage-backed securities, and borrow cash for a few days. Most weeks, this thing barely moves. We're talking minimal usage. It's just sitting there as a backup. But at the end of October, it suddenly spiked. Over $50 billion in new borrowing in a single week. That's not normal. That's banks scrambling for liquidity. Now, in finance terms, this is called a funding squeeze. In plain English, the system needed emergency cash to keep operating smoothly. And here's why that matters. This is exactly the kind of strain that tends to appear before broader financial trouble shows up. Think of it like this. When you see smoke, you don't wait around to see if there's a fire. You pay attention. So what's causing this squeeze? Well, that's where the government shutdown comes in. The timing here couldn't be worse. Congress is deadlocked. The government is shut down. And when the government freezes payments, the effects ripple through the entire economy fast. Federal contractors aren't getting paid. Small businesses that depend on government projects are losing cash flow. Food assistance programs are stalling. And all of that slows down the movement of money through the system. Banks feel this first. Imagine water flowing through pipes. When one source dries up, pressure builds everywhere else. That's what's happening right now. But it's not just the shutdown. There's a bigger picture here. Interest rates are still at 2-decade highs. Credit card balances are climbing. Auto loan delinquencies are going up. Households are falling behind on payments, borrowing less and spending less. When borrowers miss payments, banks lose income. And when the government delays funding, that income gap gets even wider. So what do banks do? They tighten credit. They make it harder for people to borrow. And that just feeds the cycle. We're also seeing people start to get nervous. And when confidence weakens, people begin pulling money out of banks just to feel safe. Not in a panic. Not yet. But quietly. Slowly. And that's how bank runs start. Not with headlines. With whispers. Now, here's where this gets serious. This isn't just about 1 week of borrowing. This is part of a bigger trend. We've seen this movie before. Let me take you back for a second. In 2019, banks quietly started borrowing billions through short-term lending markets. It was a small sign that liquidity was drying up behind the scenes. A few months later, the pandemic hit, and the Federal Reserve had to step in with trillions of dollars to keep the system from freezing. Before that, 2008, same pattern. It didn't start with headlines. It started with cracks. People missing mortgage payments. Banks over-leveraged. And then confidence collapsed almost overnight. When Lehman Brothers fell, credit markets seized up. And what began as a liquidity problem turned into a global financial crisis. That's the danger with these moments. They build slowly, quietly, until suddenly the system can't breathe. So here's my take. We're seeing familiar warning signs again. The difference this time: it's hitting ordinary people first. Families are relying on credit cards just to buy groceries, pay rent, cover medical bills. Debt is growing. Payments are falling behind. And when millions of people are in that position, banks start feeling the same pressure households do. Not enough cash on hand. Now, add the government shutdown. Federal workers missing paychecks. SNAP benefits delayed. Contractors running out of funds. That means less spending, fewer payments coming in, and more strain on banks, just as credit is drying up. So what do banks do? They go to the one place they can, the Federal Reserve. They hand over their safest assets and borrow quick cash. That's why we saw that $50 billion spike. It's not just a number, it's a signal that money is tightening from both directions. People struggling on one side, institutions scrambling on the other. Now, is this a full-blown crisis yet? No. But it's the stage where the Fed quietly steps in to keep the system breathing. And here's the problem with that. Every time liquidity gets rescued with emergency lending, it comes with a cost. It risks more inflation later, a weaker dollar, more uncertainty for savers and retirees. It keeps the system alive in the short term, but it also shows just how fragile confidence has become. So what do I think happens next? In the short term, I think we're going to see more volatility. Markets could swing. Savings account rates might change. And if liquidity keeps tightening, we could see banks start restricting credit even more. The real risk isn't that the entire system collapses tomorrow. The real risk is that confidence keeps eroding slowly until something breaks. And that's what we need to be watching for. Let me tell you why this matters on a personal level. Think about retirees right now. People living on fixed incomes, Social Security checks, pension payments, Medicare coverage. When liquidity tightens like this, it doesn't just affect Wall Street. It affects real people trying to live their lives. If banks feel the squeeze, they pull back. They make it harder to get loans. They change rates. And when markets get volatile, retirement portfolios take hits. And here's the scary part. Confidence is everything in banking. Banks don't keep all your money sitting in a vault. They invest it. They loan it out. That's how the system works. So when people start worrying, even just a little, about whether their money is safe, they start withdrawing it. And if enough people do that at once, you get a bank run. Not because the bank is actually failing, but because fear becomes a self-fulfilling prophecy. That's what happened in 2008. That's what almost happened in 2019. And that's what we need to avoid now. So if there's one lesson here, it's this. The system runs on confidence. And right now, with the government shut down and banks borrowing emergency cash, that confidence is being tested. All right, so what should you actually be doing right now? First, stay informed. Don't panic, but don't ignore this either. Watch how banks respond. Pay attention to any new emergency lending programs from the Fed. Keep an eye on interest rate announcements. The more transparent the system is, the less fear can take hold. And fear is what triggers the real damage. Second, make sure your emergency fund is solid. I'm talking 3 to 6 months of expenses in a high-yield savings account. Not because I think banks are gonna collapse, but because if you rely on government payments or federal contracts, you might face delays. Third, check your FDIC coverage. If you have more than $250,000 in one account, split it up across multiple banks. Your deposits are insured. But why take unnecessary risk? And fourth, this is the most important one. Don't make emotional decisions. Don't pull all your money out and stuff it under your mattress. Don't panic. Sell your investments. Don't do anything drastic based on fear. The people who lose money during times like this aren't the ones who stay calm. They're the ones who freak out and make impulsive moves. So my advice? Stay rational, stay patient, and keep your eyes open. Because the real danger right now isn't the shutdown. It's the panic around the shutdown. All right, let's bring this home. Here's the bottom line. Banks borrowing $50 billion from the Fed in 1 week is not routine. It's a warning sign. Add in a government shutdown, rising debt, and tightening credit, and you've got a situation that deserves your attention. Does that mean your bank is about to fail? No. Does it mean you should be aware and prepared? Absolutely. So keep an eye on what happens next. Watch how Washington responds. Watch how the Fed responds. And most importantly, don't let fear make your financial decisions for you. Now I want to hear from you. Do you think this is just routine market mechanics? Or are we watching the early signs of something bigger? Drop a comment below and let me know where you stand. And hey, if this video helped you understand what's really going on, do me a favor and hit that subscribe button. I break down money, markets, and the economy every week in plain English. No hype, no panic, just real talk. All right, that's it for today. Stay sharp, stay informed, and I'll see you in the next one.